probably, we've said at best what you're likely to see, at best, I would stress, is a sideways ranging market this year that could drift lower. If they start to tighten policy, or there's a much stronger real economy than we expect, which sucks up liquidity, then you're going to get a more pronounced drop in the market. But at the moment, it's being underpinned as best they can by liquidity.
Hey everyone, my name is Anthony Fatsis and welcome to another episode of the WTFinance podcast. On this podcast, I have the pleasure of welcoming back very popular guest, Michael Howell. So Michael is the founder and managing director of CrossBorder Capital, which is now going to be renamed GL Indexes. So Michael, thanks so much for coming back on the podcast.
Well, Anthony, it's always a pleasure. Thank you for the invitation.
No problem at all. Looking forward to the conversation. A lot has changed since we last spoke 6 months ago from a liquidity perspective, geopolitical perspective, probably all aspects. But what are you currently seeing in the economy and markets at the moment?
Well, I think what we're seeing is actually the unfolding of a pretty normal cycle. When we last spoke, liquidity was sort of coming up towards a peak. That peak seems to have now been established. It's passed. We're starting to see a decline in the rate of growth of liquidity globally. So that's really referring to the flow of money through world financial markets. It's not that it's falling. It's much more the fact that it's slowing down. I mean, that's really the key thing. Markets tend to price at the margins. So these fluctuations in growth or slowing of growth tend to be really important. And I think that's what we're seeing. If you look at a lot of the major indexes, they're flatlining to down really since late last year. The actual peak of the liquidity cycle we put about the end of Q3 2025. So, in the following 6-9 months, I mean, we've basically started to see markets kind of tread water at best, but they're finding it tough going. And what you're also seeing is the sort of key word is rotation. We're seeing very clear rotation out of initial leaders in the market, like technology, towards later cycle areas like energy, commodities. I mean, they've really been the stars over recent months.
Okay, interesting. So how does this sort of liquidity cycle compare to previous ones? Is it pretty standard? Is it different? How have you tracked that?
Well, it's in actual fact, it's a sort of a textbook cycle, if there is such a thing. I mean, we normally think of the liquidity cycle as sort of spanning about 5 to 6 years, and in actual fact, it's precisely 65 months is what we found historically by analysing the data empirically. And this has been what seems to be an absolutely normal bang-on cycle for that length. And in actual fact, the last two have been absolutely on track in terms of that timing. And if you look at, you say, is this a sort of a standard or normal cycle? I mean, the answer is yes, in many ways, actually more so than any other. Curiously, the way that sector performance has unfolded, the way that asset class performance has unfolded is very much in line with what we would sort of theoretically expect. In fact, much, much more so than maybe earlier cycles. So this one is absolutely moving like clockwork in a very predictable way. And, what we should be seeing now is sort of signs that bond markets are beginning to get a bid. We should be seeing signs that investors are moving towards the safety of sort of safe haven assets. That would ultimately include the dollar, but the dollar not yet. You're certainly seeing performance from maybe mid to later duration bonds beginning to pick up unusually, because that's been the asset class that everyone is saying is the worst one possible and everyone ought to dump. But actually the performance has been pretty good of late. And obviously things like gold, precious metals have really been outstanding performers recently.
Yeah, interesting. And what changes have we seen to liquidity recently? Is it quite obvious changes? Has it been sort of harder to track? Because from my understanding, what you say is it's not that liquidity isn't growing; it's just the rate of growth is sort of slower than it has been previously.
Yeah, I think the first thing to say is you've got to sort of envision two separate circuits of liquidity. One which travels through financial markets, which is really the initial one, and then the second one where liquidity spills over into the real economy. And the point is that all money that's anywhere, must be somewhere. So if it's in the financial sector, it's not in the real economy. And similarly, if it's in the real economy, it's not in financial markets. So what we're starting to see now is not so much that central banks are tightening. I mean, there's been one or two examples like the Bank of Japan or the Reserve Bank of Australia that have lifted interest rates. But it's much more the fact that liquidity is now starting to shift from the financial sector increasingly into the real economy to feed what is a probably a rapidly expanding world real economy. And that's what the evidence is very clearly showing. So it's not the fact that policymakers are putting their foot on the brake yet. I mean, that will probably come at some stage in the next 12, 18 months, because inflation pressures will undoubtedly start to pick up. That will cause skittishness among policymakers. They'll start to raise interest rates, they'll tighten liquidity conditions, etc. But that is down the road. What's happening right now is that liquidity is slowing down in financial markets simply because the real economy is starting to accelerate, and that's dragging liquidity out. So that's the reason that you're getting this shift. And consequently, that's underpinning late cycle areas of investment like commodities that clearly get a lot of their bid from a stronger economy.
Yeah, really interesting. Is that sort of I guess maybe a crude way to look at it is shifting from lots of buybacks to more capex? Is that sort of a way that we see that, or how else can we see that shift?
Well, that's a very good way of putting it, because that's one of the details that you would expect. And you can see very clearly in the US market with not only working capital demands increasing, but also demands for more capex, particularly in the AI sector. It's actually forcing a lot of those formerly cash-rich AI companies or tech companies to actually pare down their treasury balances, where they've been keeping a lot of their cash, take it out of financial markets to actually spend on new AI. Not only that, but they're actually coming to the market now, and they're actually seeking to raise capital. So that particular process is directly taking money out of financial markets to spend in the real economy. But it's not just the private sector that's doing that. I mean, also it's one of the intentions of the US Treasury to actually make that move as well. But that's something we can dig into later.
Yeah, it's super interesting. So if we look at bonds as well, you say there's sort of a rotation into bonds at this stage. I guess does that help to increase liquidity? Because it's challenging to see, because obviously the value of the bonds will go up, but then the yield's going to go down, and then the money's coming out of other parts of the financial market. So how does that sort of relationship intertwine?
Well, it's a complex
Maybe
relationship.
collateral, yeah.
Because the fact is that bonds increasingly are used as collateral in the system. So if you've got basically rising bond prices, your collateral is going up. So there's actually more capacity to lend. The question is that where is that lending being directed? Is it being directed into financial assets, or more likely in this case, or this is the fact that's happening, money is going into the real economy. So the collateral base of the economy is improving. There's no question about that. But at the margin, more and more money is being siphoned off into real activities.
Okay, yeah, super interesting. And then I guess the big theme to this week and the big news has been geopolitics, sort of the current war in Iran, and the US versus Israel as well. This is going up tomorrow, so I'm assuming that the conflict won't be over yet. How do you see these sort of conflicts normally impacting liquidity, or is it more just it's too short term to actually have an impact?
Well, I think the answer is that if you look at the long-term picture, it's very unusual for geopolitical episodes like this to have a serious impact on the liquidity cycle. The liquidity cycle tends to be much more of a super tanker that sort of takes months or years to actually change direction. So you tend to see, as I said, 5 to 6 year cycles, and geopolitical events tend to be random, but they tend to be much shorter term. So they can have a big impact short term on sentiment, investor sentiment. There's no question about that. But they tend not to change the ultimate direction of liquidity, except if they do. And there are occasions. I think back to what happened in the late the late 1980s, early 90s, with the fall of the Berlin Wall and the events around the fall of communism. That was something that did change liquidity conditions, fairly significantly. But generally speaking, it tends to be a rare event, and this doesn't seem to have although as bad as this particular conflict sounds at the moment, it really hasn't got the impetus to change the direction of global liquidity as we speak.
Yeah, I imagine it's those big secular shifts, as you said, for the Berlin Wall, so opening up of Eastern Europe. Imagine opening up of China as well. These massive secular shifts are more the ones that have impact first. I guess if Iran came onto the global stage, it would be beneficial, but not as large as those events.
Yeah, I think that's true. It's not to denounce or to belittle the importance of Iran, because if Iran came back into the world economy, I think it would be significant both for the world economy and for the Iranian people. But the fact is that in terms of the big picture, China and Eastern Europe tend to be a lot more important in the world economy.
Yeah, super interesting. So we've talked a lot about the US, I guess the West, and so what's happening in China? Because I know that's something it's been quite an interesting and unique liquidity cycle versus the rest of the world.
Yeah, I mean, China's a very interesting country from a lot of perspectives, but I would argue foremost because the way that many people perceive what China is doing, I think, is wrong or incorrect. And actually, China is facing a lot of economic challenges. I think we kind of realize that. Clearly worsened by tariffs. I mean, that's not helping the Chinese economy at all, given its export focus. But the reality is that there's a sort of bigger problem looming over China, which is the debt problem, and China needs to get out of debt. And what's more, it's sort of facing that challenge at a time when the US dollar is being weaponized, or certainly the US monetary system is being weaponized against China. So China has to sort of try and steer its way very carefully through these challenges. And I think that what we're seeing anyway is the vent for that is being expressed through the gold market or the precious metal market. And the question really people have got to ask is the strong rise in gold and silver and generally precious metals to do with what the West is doing? Is it really a monetary debasement trade, or the great debasement trade as people label it? I don't think it is. Or is it more particularly a sort of specific event which is being launched by China to try and devalue its currency, or in other words, more particularly, devalue its debt? I think it's actually the latter. So I think the movements in gold, silver, and precious metals have a lot more to do with China. They've got the China imprint stamped on them rather than what the West is doing. I'm not saying the West will not participate at some stage in that process. They will probably have to debase their currencies to a much greater extent than they're doing at the moment. But it's not really on the agenda right now. What's driving the gold price, I think, is much more China's efforts than anything else. Now, we can dig into that. And maybe this is time to look at a couple of charts. And I think there are sort of 3 or 4 charts of liquidity that really matter right now. This is the first one that we can look at. And this chart is basically looking at the global liquidity cycle. And what it's showing is that tempo of 5 to 6 years. So in other words, the black line represents the momentum, the underlying momentum of liquidity. It's shown as an index, but beneath that is actually a series of different growth rates. So it's looking at the underlying growth rate of all the components of liquidity that we monitor over about what is 90 economies now. So this is a sort of hybrid of growth. So it's looking at an unambiguous signal or attempts to create an unambiguous signal of liquidity. And the red dotted line is really trying to help the eye. And this is a sine wave that we fitted to the data. Actually, we fitted it in year 2000. So in actual fact, what you've had is 25 years to actually see whether that works or not. It was previously fitted but using Fourier analysis, which is a mathematical technique to try and understand cycles. And actually, since then, we've given the data to an independent organization in the US, the Foundation for the Study of Cycles. That's their bread and butter. They looked at this in detail using their algorithms and came out with exactly the same analysis, that this is a 65-month cycle. So that's clearly reassuring. And if you look at the last 2 cycles, it looks as if the timing has been absolutely spot on. So the cycle peaked exactly where it should have peaked back in 21. It bottomed exactly where it should have done in late 22, in fact, in October of 22. And it seems to be peaking, albeit at a lower amplitude than maybe than the previous cycle, but it's peaking pretty much spot on around about the end of the 3rd quarter of 2025. And it's now starting to drift lower. So this is the cycle. And I should stress as well that this cycle is, first of all, the flow of money through financial markets. So it's not looking at the real economy here. And secondly, what it's doing is it's focused on the advanced economies. So China has taken out, and you'll see why China's taken out in a second. So that's basically the picture. Now, I just want to move on in this presentation a tad to try and show a couple of things that are important in terms of understanding the cycle. And I'm just going to get, back to, I'm going to get back one to this. And what this is showing is the interpretation of the cycle. So if you envision that previous data cycle and then you fit it to this schematic, you'll see that the schematic is trying to argue that around the peaks in the cycle, commodity markets are very strong performers. In the upswings of the cycle, equity markets are the best performing asset class. In the downswings, you want defensive assets. So in other words, it's a risk off phase, and cash tends to be initially certainly one of the best asset classes to own. And then as you get towards the trough, you want to be shifting much more aggressively into longer duration government bonds as safe assets and benefit from what are likely to be prospective interest rate cuts. And then the cycle restarts. And also what we show on that is positioning for different industry group sectors, or what yield curves, in other words, the term structure will be doing at different phases. And this is the blueprint of what is an average cycle. Now, another way of looking at that is through these traffic lights. And these traffic lights are basically saying, on the left-hand side, you've got asset classes. On the right-hand side, you've got industry groups. Traffic lights are traffic lights. So it says green is go, red is stop, amber is proceed with caution. And what this broadly says is that in the rebound stage of the liquidity cycle, the early cycle upswing, you want to be taking a bit of risk. You want to be in equities and credits. You don't want commodities or bonds. By the time you get to calm, that asset allocation has shifted a tad. You go much stronger risk on. You want more equities. You want more commodities. You want to be paring back credits, and you still don't want bond duration. By the time you get to speculation, where the US market is now, you basically want to be out of credits. You want to be paring back equities. You want to be still full on with commodities, and you want to be sticking your toe in the water in bond duration. And that's really how the asset allocation cycle unfolds. For industry groups, it's exactly the same analysis. So you start to think about cyclicals in the upswing of the cycle, rebound and calm. You want defensive areas in the downswing. You lead with technology. They tend to be the strongest performing area of the market in the rebound and calm phases, and that was certainly true. By calm, that phase, I mean, think of that as really lasting over the last 12, 18 months. Financials tend to be strong performers. I mean, that's certainly been the case. They're starting to lose their luster now as the yield curve begins to peak out. Energy commodities are really where you ought to be positioned now. They do well in calm speculation. And then progressively, as the cycle begins to deteriorate more, you want more and more defensiveness, like utilities or consumer staple stocks. So, as I said, I mean, this has been, if you like, a blueprint which has worked remarkably well this cycle, almost to the letter. And this cycle has unfolded like clockwork through these different phases. That's unusual. I mean, it's never been quite as precise as that, but it's worked pretty well. But this is really a standard blueprint that we tend to look at to try and understand asset allocation, which has been informed by looking at decades of data on asset allocation. It's not always the case it will work, but it seems to have certainly worked remarkably well this time around. Now, the last thing I want to say on this section is to think about what's happening to the world real economy. And this chart is looking at the performance of sectors within the MSCI World Index. Now, the black line is showing that relative performance between cyclicals and defensive stocks. And the orange line is looking at the world business cycle as calculated by looking at a whole array of different business surveys, like the US ISM, the Tankan in Japan, the IFO survey in Germany, INSEAD in France, CBI in the UK, weighted by GDP, put together into that orange line index. And you'll see that the black line pretty much follows that, or even predicts it a tad. And this is looking at the internals of the stock market, which is one of the favored indicators of the famous US investor Stanley Druckenmiller, who always claims this is a much better guide than economists to what's really happening in the economy. And it seems to be unfolding right now. Now, bear in mind that the liquidity cycle precedes this by around about 12 months. So the liquidity cycle gives you the opportunity to be well ahead of the business cycle. And you can see that probably very clearly here. And this is tracking almost contemporaneously with a very small adjustment we made to make it easier on the eye. But this is looking at the world business cycle again, so that previous data in black. And the orange line is looking at what global liquidity does. Now, as I said, bear in mind that liquidity is leading, but you'll see there that the peaks in liquidity tend to coincide with troughs in the real economy. And equally, periods where you get very weak liquidity tend to be periods of strength in the world economy. So the two cycles move asynchronously or completely, in completely opposite phases. Therefore, if you start to see liquidity going down, as we're seeing now, it tends to coincide with a pickup in world business activity, which, as I indicated right at the beginning, this is because working capital demands are increasing, because capex spend is going up. And as you rightly said, share buybacks are coming down and capex spending is going up. So this is articulating exactly that phenomenon. It's not the central banks are tightening yet. It's much more the fact that the world real economy is starting to take more liquidity and crowding out the financial sector.
Okay, super interesting. Thanks so much for explaining that. So if we look at the world business cycle, it seems like it's been sort of quite flat the past few years, but then you compare that to the US, and the US economy has been, really booming, it seems. So is this more to do with other countries outside the US? I guess Europe's the Japanese. I think you said it excludes China. So it seems like this is a more ex-US countries that are really going to perform, or is it also the US?
Yeah, no, I think you're absolutely right. But I would say that, the other thing that you could discern by looking at this previous chart is that the orange line has decoupled from that black line. Now, is that the case because there's something unusual going on? Have financial markets sort of got ahead of themselves? Well, historically, if you look at the performance, they tend not to. They tend to be not bad predictors of economies. Or it could be that the economic data is just, for whatever reason, is suppressed or giving the wrong signal. And that may be the case. So it may be that the world real economy is stronger than actually data or business surveys would suggest. That may be the case. I mean, certainly if you look at commodity markets, they're kind of on fire. So they would suggest there's a lot more impetus going in economies than we see in terms of business surveys. So, that could be one reason. The other thing, which is the other point I was going to make, is to look at this subsequent chart, which is tracking liquidity between the US and China. And I think what you alluded to, Anthony, is actually spot on, that there is something unusual going on with the distribution of economic activity worldwide. And you can see this through the data on liquidity, because the orange line is registering what China is doing. The black line is showing what's happening in the US system, financial system. Those cycles between the US and China were absolutely on track together. They were very closely in step and synchronized in the early 2000s. And that was a period where China was integrating into the world economy, and particularly the WTO, the World Trade Organization. So China was desperately trying to align its economic and monetary policies with the West, and particularly the US. And then you start to see, as the years unfold, and particularly you pass through the period of the bubble in China, just after the GFC, following the big stimulus that China undertook, that bubble required the Chinese to actually run a very tight monetary policy for a long time. Hence, that orange line is depressed. They were very focused on stabilizing the yuan currency against the US dollar, which actually dictated a tighter policy, because the dollar, as you recall, was very strong during that period. And now what you're left with is a monetary stance or monetary policy in China that is completely out of step with what's happening in the US. So as the US is now, or conditions are tightening, you're seeing in China that liquidity is beginning to ease. And that's something that we ought to be thinking about, because it will clearly inform asset allocation.
Yeah, and is liquidity measured in US dollars, or do you sort of remove the US dollar movements? Because I wonder if that's, obviously the dollar has been quite strong in the past.
Yeah, this is actually based on, this particular chart here is based on local currency analysis. So this is the growth rate of Chinese liquidity in yuan, and it's the growth rate of US liquidity in US dollars.
Okay, that makes sense. And I do wonder, we've mentioned at the start of the interview about, I guess, probably all economies are looking to do more government-led, top-down industrial strategy. So I do wonder if that's what we're seeing with the disconnect of, Europe and the UK and obviously the US as well are actually trying to shift how their economies are run and actually be trying to direct to these, I guess, essential sort of industries that they want to try and keep onshored. Do you see that maybe having an impact as well with why we're seeing a bit of a disconnect?
No question. I think that's a large part of the reasoning. And if you look at why US liquidity is dropping in this way, is to a large extent because what you've got going on in the US is an explicit shift from what we've labeled Fed QE towards Treasury QE. That the Treasury is much more active now in actually injecting liquidity through its mechanisms into markets, or actually more accurately into real economy markets, than the Fed, who was basically holding a hose and sort of misdirecting it, or sort of soaking everyone intentionally or unintentionally. And the Treasury QE is much more focused into the real economy, and that's exactly what Besant and incoming Fed Chair Kevin Warsh basically say they want. They don't want the Fed to be so active. They want a smaller Fed footprint, and they want the Treasury to be much more active in terms of a driver of the US economy and US policy. And that's the direction it's going in. Now, I can demonstrate that if I've got to go forward a lot in the presentation. But if I shift towards, coming up in a second here, right, one too many. So this chart is basically looking at the distribution of stimulus in the US in this sort of three-colored chart. And what it shows is that the orange area is basically what you would think of as maybe sulla tabla, or not QE, is what the Federal Reserve has been doing outside of the headlines. So in other words, it's things like changes in the Treasury General Account, all very wonkish things, changes in the bank term funding program, things like the reverse repo facility, all those elements which are somewhat arcane movements, but inject liquidity into the system, are shown there. The red area is traditional QE, so that basically is this balance sheet expansion. The black area is what we call Treasury QE. Now, let me just explain what Treasury QE is, because it's maybe not obvious, and it's a very wonkish sort of in the weeds concept. It's all about changing the maturity of debt that's being issued by the US Treasury. Now, if the Treasury issue very long dated debt, in other words, let's say 10, 20, 30-year debt, it tends to be bought by long-term institutions like life insurance funds or pension funds traditionally. And that comes out of existing savings. So it's not really a monetary stimulus. It's just changing the sort of duration or the maturity of holdings in the economy. And it shouldn't have any significant effect on economic activity. If, on the other hand, they start to issue very short-term debt, in other words, Treasury bills, which are basically securities with maturities of 3 months, 6 months, even up to 12 months, those securities tend not to be bought by longer-term institutions. They tend to be bought by banks. And if banks buy government debt, that is monetization. So the banks basically fund those purchases by expanding their balance sheets, which in conventional parlance means money supply increases. So the greater the use of the black area in that chart, the more that the Treasury is controlling spending, and it's funding it through monetization courtesy of the banks. But that money is not going willy-nilly into financial markets and pushing up asset prices. What it's doing is going into the real economy for things like defense spending or investment in critical minerals, or whatever the strategy of the administration tends to be. And this is a policy that was first used by Janet Yellen, and it's basically been copied by Scott Bessent. Even though he said he wouldn't do it, he's using it significantly. And what's more, it's a policy that has now been mooted in the UK and in Japan as a way for governments to operate. So it's been pretty successful. And you can see from the little window that we've put in where we've got the sort of the outline of that stimulus in orange. It's that orange line. The black line is the change over a year before in the US ISM index. So this is basically illustrating the fact that actually that stimulus tends to be very beneficial for the economy. So it should be very likely that you start to get a significant pickup in economic activity through this year in the US economy.
Interesting. But then I guess as you've mentioned before, it probably has less of an impact on the financial markets. So.
Yeah, the financial market bit, I mean, to be clear, is the Fed QE, which is the orange and red areas of that chart. And if you look into 26, they're virtually disappearing. So that's Fed liquidity, or Fed QE, if you like, being displaced by the black area, which is Treasury QE. It's that straightforward.
Yeah, super interesting. So putting it all together, it sounds like for 2026, you see, markets at least not rising as much as they have. They've had some pretty amazing performances the last few years, especially in the US. And you see sort of, as you said, a more rotation into these energy, defensive, etc. That's what you're seeing for the year.
Yeah, exactly. I mean, I think
later,
I mean, it's fair to say that the US Fed is not operating a monetary policy that is conducive for a continuing strong bull market. It's not operating a monetary policy yet that is consistent with a bear market, but probably, we've said at best what you're likely to see. At best, I would stress, is a sideways ranging market this year that could drift lower. If they start to tighten policy, or there's a much stronger real economy than we expect, which sucks up liquidity, then you're going to get a more pronounced drop in the market. But at the moment, it's being underpinned as best they can by liquidity. And I think you can see that the Fed is not in any hurry to tighten, because the tensions that we saw at the end of last year in the repo markets that were caused, should I say, by a relatively small drain of liquidity out of money markets of about 200 billion. That caused some big spikes. I mean, I can evidence the spikes here. Whoops. Here. This is what happened in the repo markets, which is looking at the SOFR interest on overnight reserve balance spread. So in other words, you can think of that as market rates being SOFR, market rates in the repo market, minus, let's say, Fed funds for simplicity. That spread, which spiked up at the end of 2025, basically was triggered by a shortfall of about 200 billion in the money markets, which arose for technical reasons, largely because the Treasury General account was very suddenly jumped. Now, the Federal Reserve could have allowed that. They said initially at the time that they weren't concerned about the drop in bank reserves and they were going to let it sort of feed through. They balked and they changed their policy pretty quickly. They introduced a new QE measure, although they denied the fact it was QE, although that's clearly nonsensical. It's just semantics. They said that they were operating a new policy called Reserve Management Purchases, RMP, and that has basically done wonders in recent weeks for actually repairing the repo markets. I mean, there's a little bit of a pickup lately, but generally speaking, repo spreads are sort of back into or close to a normal zone again. And that's reassuring. I mean, we've got to watch this clearly for sure, because the more that liquidity tightens, the more that spread will jump. And that's clearly something that could disrupt the bond markets if you get a lot of volatility in the repo markets that will spread, largely because you've got hedge funds who are doing leveraged trades, operating via the repo market and buying treasuries. That will unravel and cause a spike in bonds. But that's not really happening right now. And it's not happening because the Federal Reserve was very quick to actually smooth the waters over when you got these sort of significant waves. So they're very active. Therefore, corollary, can Kevin Warsh, as slated, pare back the Fed balance sheet significantly? And he's talking of trillions of dollars. Answer, no, he can't. I mean, it's impossible. I mean, it may be on his wish list, but it would just be impractical to do that. The Fed's footprint in markets is big, and it's got to remain big, and that's the fact of it.
Okay, but you don't think they continue the QT while maybe implementing these?
I mean, look, they can do it, but it would be a reckless policy. It would be akin to driving over a cliff. at high speed. I mean, okay, I'm not going to say they wouldn't do it or they couldn't do it, but it would be a reckless policy to try and enact, simply because the Fed's balance sheet needs to be bigger. I mean, the reality is that the world has changed enormously, since 2008. We've got to recognize that. I mean, first of all, there's no big interbank market now. The fact of the interbank market's been taken onto the Fed balance sheet. Think of it that way. You've got a huge repo market, which is collateralized lending, which has really replaced that. And collateralized lending needs collateral to be nurtured. And most of that collateral is in the Treasury, securities. So if you saw volatility in the Treasury market, the Fed would definitely have to come back to smooth that over whenever you've got these spikes. And the third factor is that somebody else benefits enormously from the Treasury market, which is the government itself. And fiscal debt or Treasury debt is up fivefold, if my memory serves me correctly, since the 2008 financial crisis. So the footprint of the public sector, the government sector in the markets is enormously bigger. And the fact is that it may be on the wish list for them to shrink it, but people are talking glibly about the Fed footprint disappearing. They're not talking about the fiscal footprint of the US government or any other government for that matter shrinking. I mean, it's an impossible task for politicians to do, because most of that driver or impetus behind government spending is entitlement programs. In other words, welfare state. I mean, there's no way that any politician is going to stand up and say enough is enough. I mean, it would take a crisis like Argentina to do that. We're not there yet.
Yeah, and that's where the debasement trade comes from, as you've been mentioning.
Yeah, I mean, it's a long-term debasement, but it's not, I keep stressing, it's not what's driving markets right now. I mean, it's a nice theme to think about, and it's one that everyone ought to, have in the back of their minds. And you need monetary inflation hedges in portfolios, but the surging gold price has got nothing to do with a general debasement trade in the West. In actual fact, you'd say the opposite. And I want to show, if I can, and I may have to go back to an earlier chart. I mean, this one is a wonkish chart, but it's a really important chart because it spells out exactly, I think, what's going on right now. And this is looking at the global liquidity index, which is the orange line again, same data that you've been looking at. The black line is looking at world term premium. In actual fact, it's the change over 12 months in world term premium. Now, why are those two lines connected? Well, first of all, let's explain what term premia are. Term premia are the extra amount that investors demand for holding bonds over the full term of their issue. So, in other words, that the risk premium, if you like, for holding a 10-year bond is a lot bigger than holding a 1-year bond, because you've got more time for things to go wrong. In other words, you're protecting yourself against interest rate uncertainty in the bond. And therefore, you tend to find that term premia are much bigger the more you travel down the maturity structure. So 10-year, 20-year bonds have much bigger term premium than 1 year or 6-month bills or bonds. The point about this chart is that another factor that drives that term premium, and I should say that term premium have been the biggest impact or had the biggest impact on driving bond markets in the last 15 years than anything, and than interest rate expectations or other factors. It's all about term premium movements. Those term premium movements also reflect the demand for safe asset or safe haven assets. If you start to see a lot of liquidity in the financial system, term premia will tend to be bid up. In other words, investors shun government bonds. They sell their bonds because in a very generous liquidity environment, there are much, much better assets to go into. And investors tend to be risk seeking during an abundant liquidity period. And therefore, they go out of safe government bonds, safe boring government bonds. They go into equities or corporate debt or commodities or real estate or whatever. As you start to see liquidity shrinking, so you see investors reversing that trade. They tend to be concerned about systemic risks. They think that default risks in the financial system will be greater in a tighter liquidity environment. That's a reasonable assumption. And therefore, they start to get out of risk assets and they go for government bonds. And those government bond prices rise. Their term premia tend to be bid down. Therefore, you would expect to see as I say, expect to see a very close correlation between term premia and the liquidity cycle. And lo and behold, you see it. Those are two completely independent sets of data. One is a rate from the term structure, which is the black line, and the other is a rate of growth, which is taken from liquidity data, quantitative data. But they seem to line up pretty well. And what this is showing is as the rate of growth of liquidity deteriorates, as we're seeing now, so term premia tend to drop. And that's exactly what you're seeing. So in other words, there's an increasing demand for safe assets. So this is just the asset allocation cycle unfolding. And this is why basically you're seeing a situation whereby bonds are remarkably stable. And in fact, despite all the nonsense that's written by, particularly by the media, about bond markets being a sort of atrocious investment, the fact is that in the last 9 months, bonds have been not bad. In actual fact, the term premium across many bond markets has been, unbelievably stable. And this is, as I say, the cycle unfolding. So what we're seeing is not the great debasement trade. We're seeing rather the opposite, ironically. We're actually seeing monetary conditions tightening, which is why investors are going back to bonds. And the simple fact is that if we were seeing, a general monetary debasement, bond markets would be selling off, and they simply aren't.
Yeah, really interesting point. So, Michael, thanks so much for your time today. We sort of covered so much on the global liquidity markets, geopolitics, etc. But my last question is, what is one message you want people to take away from our conversation?
Well, I think the one message is just to look at one final chart, which is what's happening in China. And you've got to understand, this chart. This is what China is doing. So I identified earlier on the fact that the Chinese liquidity cycle is out of step with America's. The Chinese liquidity is expanding. This chart here is looking at net liquidity injections into Chinese money markets on a daily basis, which is why there's so much noise in that data. And what it's actually showing is the year-on-year increase in that liquidity. So what you're seeing is a general uptrend in liquidity injections, which have accelerated noticeably from the beginning of 2025. And why is that important? Because this is China trying to get out of its debt problems and, if you like, devalue the yuan internally against real assets. One of the corollaries of that is that the gold price goes up. So if you want to understand what's happening to gold, don't look at gold in dollar terms, look at gold in yuan terms, renminbi terms. And I think this chart has 40,000 easily written on it. And those little corridors are basically illustrating where you get I think, targeting by the Chinese authorities. But they want gold to go up. And I think the whole architecture of the international financial system is changing, with gold being a very important backing ultimately for the Chinese currency. And this chart is one that people very often cite as to say what is happening in the gold market, and the fact that real interest rates shown in black have lost their mojo, if you like, in terms of driving the gold market. And you can see the big disconnect that I've highlighted there between gold and real interest rates. That is what people talk about as the great debasement. It ain't a great debasement, it's a Chinese debasement. And if you look at this chart, this is showing the previous data on PBOC, China's People's Bank's liquidity injections in black against the gold price in dollars. And you can see that those charts seem to be spelling out the message that this is all about China. And not only Chinese residents are buying gold to protect themselves against monetary inflation, but the Chinese state is buying gold to back its currency. It's going to keep going.
Perfect. Great message. So, Michael, thanks again. If anyone wanted to find out more about your work and what you do, where would the best place for that be?
Thanks, Andy. I think the best place is Capital Wars, which is on Substack, where we write commentary, 2, 3, 4 times a week on what's happening to markets, provide some data. If you want full data access, that's our institutional service, which can be found at glindexes.com. And we do occasional tweets of what's going on Twitter, where the handle is at CrossBorder Cap, which is the the former incarnation of what we do.
Yep, perfect. Great. I'll put that all in the description. But thanks again for your time.
Thank you.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment. Good or bad feedback, I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right, thanks again.